Hey there, boo-boo. You gotta get the pips from the picnic biscuit. Hey, good morning. How are you? Welcome to Monday. Welcome to Monday. Welcome to Forex.Today, the YouTube channel. Almost 20,000 foreign exchange traders. Holy smokes, eh? Oh, for sure. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades based on technical and fundamental analyses. Mark says something about a haircut. What haircut? So anywho, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. But please stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. So my name is Wayne. I love trading. I quit my job as a venture capitalist, which at the time I thought was my dream job, but then I found Forex. I started studying Forex and trading Forex for a couple of years. And then, you know what? I quit my job to become a full-time Forex trader. As I traded and matured and got better and better at technical analysis, I realized there was still something important missing. And I didn't really know what it was. After studying for my Series 3 examination, I realized there's a thing called fundamentals. I knew there was news and stuff, but wasn't quite. So anyways, I realized when I was 40 that I only had about 25 years left in a career. So I decided to go to Harvard and get a macroeconomics degree. You know, like most people. Hey, yeah, full-time college student. Yeah, it took me 5 years. But anyways, I got that macroeconomics down. And so now here we are. I'm trying to apply both technical and fundamental analysis. And so I will try to share both those aspects of being a trader, a healthy, well-balanced trader, using economic data to create a bias, and then trying to trend trade. As you'll note through the other webinars, I don't really scalp much anymore. I'm more of a shorter term, not scalp, but like I look at like trades for the day, trades for the week, trades for the month, trades for the quarter, trades based on central banking policy, which could last many quarters. That's the kind of thing I do. But you know what? I love scalping too. I just don't really do it on YouTube. I don't actually really do it at all. I scalp in, but I let it run. So anywho, let me know how I can help. I'm willing to share. There's a lot that we can do together, but this is your time. You're the boss. I am the servant. Makes me sound like Jim Morrison, huh? Ride the snake. No, I said servant, not serpent. Oh man, look at this. Too casual. I'm in the office. Too casual. Come on, Wayne. Get professional. Anywho, so let me know how I can help. Today, I suggest we go over the calendar. We got a lot of stuff going on this week. But let me know how I can help and how I can serve you. Been doing these live streams a while. Approximately almost 20 years. So there are 6,000 videos on YouTube associated with my work. If you look at the description below the video, you will see a link to the FX Bootcamp YouTube channel, the Trader's Way YouTube channel. If you go to the FX Street YouTube channel, you'll see that I've been doing something called Trade Non-Farm Payrolls Live for more than 16 years every month. So you can check out my work there. In the description below, you'll find a link to my book on Amazon.com. I wrote that many, many, many years ago. And I believe all of it is still useful today, relevant. I mean, maybe some of the data points have changed in all those years and in 10 years. But the ideas and the strategies and the thought process and my personal journey going from a horrible trader to, a less horrible trader is all good. So anyways, that's in there. A link to FX Bootcamp, which offers 65 hours of premium foreign exchange trading for $88. That's a pretty good deal, right? Less than $1 per hour. No, a little more than $1 per hour. That's not bad. I don't think that's overcharging. It's good stuff, by the way. You will get a little bit of that Harvard degree for $88. And of course, a link to tradersway.com, a trustworthy, ethical foreign exchange broker. Fast execution speed, narrow spreads, huge swaps. Sounds like a good sales pitch, huh? When the ECB pulled their peg on the euro, no, did I say ECB? Sorry. When the Swiss National Bank pulled the peg on the euro, big banks, big brokers. In fact, some of the biggest Forex brokers in the world went out of business in an instant. And apparently, it seems to me that those brokers that went out of business were trading against their clients. Trader's Way was perfectly fine. They were not in trouble at all. I contacted them, spoke to the leadership, and what's going on? Brokers are going out of business. And they're like, we executed the trades that the clients asked us to. Like, there's no problem here. And that's amazing to me. So that's how I interpret it. I don't think they trade against their clients. And I see that through actions, not through advertisements. So anyways, if you find that, refreshing that maybe they have a business model built on a symbiotic relationship, if you succeed, they succeed, maybe I can help you succeed. Maybe that's good for you. Maybe that's good for them. Maybe that's good for me. Maybe it's good for the whole world. Maybe you can take care of your family because you learned how to trade Forex. Hey, that's the dream, not the yellow Lambo, huh? Let's take a look at the world. Euro was weak until about 15 minutes ago. Something going on in the world. Taking a look here, US dollar still weak. Now, I admitted in the day trading group last night that I was surprised that was still happening, but that is still happening. I'm surprised by it, but the research showed that was still likely. So let's extrapolate, take a look at what you guys are doing. What's on your mind? Thank you for answering the poll, by the way. I appreciate that. And half of everybody here wants to do the dollar. Dollar. Remember Max Hendricks, I think his name was? The dollar. Okay, so we'll take a look at the calendar. Wow, look at that hair. What? We'll take a look at dollar for sure. I can't see if this is updating anymore or not. Is it? February. I don't think it is it? Dead. It's a dead app. I'll have to contact the people, the service, and see what's what. Yeah, it hasn't been updated since April, huh? All right, well, you're going to have to find a different service for that. What about the currency indice? And that's up to date. That's interesting. I guess maybe the code has changed on the other. So we'll take a look at that, but you'll have to get your own COT. Seems to me yen is quite weak. Hey, no, that's June. I was going to say that's wrong. So even that's dead. Oh, even that's dead. All right, so I'll have to kill that. They're not supporting the tools anymore. So, well, the index already got, but the COT's dead. Sorry, fellas, ladies and germs. So you'll have to get that data somewhere else. Interesting. I know a thing. I know, wink, wink. Do other people know? Wink, wink. I didn't know this was dead. I haven't used it in a while because you don't need COT all the time, but it's a good part of the fundamental research and breaking it down. Oh my God. Breaking it down currency by currency by currency and currency and then writing it all down. It's still important it's still important to do. It is time consuming. I used to do it through an Excel spreadsheet, and then you'd have to create these lines yourself by adding a couple of areas and then adding those up and subtracting from totals to get the other lines. And man, I used to do that. It used to take me hours, but anywho. Well, we do have a calendar, so we'll just do that now. Yeah, No, that wasn't planned. As much as it looks like that was planned, that wasn't planned. But I'm just sitting there like, For people that know what I'm talking about, they're like, that was incredible timing. I'm sitting there like, that is incredible timing, but I didn't do it. Okay. So, anywho, let's look at the week. First of all, we have manufacturing and service PMI for the United States of America. Okay, and what we're looking at is probably new orders and also inventories. Inventories are going up and GDP is going down. In a blaze of glory, right? What about oil? Do you still think long for the week? Well, we'll take a look. By the way, I have to remind you, I don't think. I do research and I analyze. Okay? So I don't have an opinion, I have a bias. I know I'm picky, but language is important. All right. So, anywho, there you go. That's why Euro popped. Okay, Euro popped a few hours ago. Okay, hasn't gotten worse, and that's good news, right? Retail sales way down out of Europe. That's terrible. So anyways, going back to the United States of America, this PMI is the first one and it's manufacturing. So we want to look at new orders and we want to look at inventories. And I suppose you also want to look at employment because, the market is concerned about the pivot, the Fed pivot, the Fed pivot. Okay, so look at the employment subcomponent of the manufacturing as well. So that's three things for you to look at. Okay. Then real estate news out of Australia. huge part of their economy, not just monetarily, let's say, but psychologically. As long as I can remember, Australians have been worried about the real estate market collapsing. A little bit after that, we get the RBA interest rate decision. Oh yeah. Governor Lowe, I remember it was winter time and it was dark because it was probably close to midnight. And I'm watching Governor Lowe speak about interest rates. And he said, no, he doesn't understand why people think Australia is going to raise interest rates. He's like, we're not even thinking about it. We're not even thinking about it until wage growth is over 3%. And now they're jacking up interest rates. Just amazing how things change, right? Things can change. So anyways, we'll see how Australia is doing, and make sure you read the statement. I don't care about the headline number. What we care about is the future. We want to look 3, 6, 9, 12 months in advance so that you're going to get that data maybe from the RBA statement. What happens today is irrelevant. Okay? Then we move all the way out to New Zealand. Okay? And we're going to get the Kiwi jobs report. Chinese PMI, interesting. Then we get ADP, another dumb prediction on employment. Now, this offers a good scalping opportunity, typically. And it shows you basically small and medium-sized businesses and the demand for employment. So once again, the Fed is interested in creating a little bit more unemployment because they expect that to impact inflation. I think it will because it does destroy demand, but I don't think that's what our problems are. So I think it'll have limited effect, except for the people that lose their jobs. It'll probably have a big effect. But then the government has to come along and give them free money so that they can pay their rent and buy groceries. And I would argue, well, why don't you just let them keep their jobs? I'd rather have them earn their money than receive transfer payments. And for most people that are on unemployment, they kind of feel that way too. Unemployed people are not on welfare. That's a whole different thing. They've lost their job. They're going to look for another job. They're embarrassed to be on unemployment, but they have no choice. I gotcha. Good. We'll want to take care of them because they're part of the workforce. Okay, remember, the workforce includes people that don't have jobs but are looking for jobs. You might have gotten laid off because of the economy. It's not your fault. You might have left your job because you're in a company that is not creating enough value to sustain itself, and they have a bunch of mediocre people just sucking up whatever's left of the resource. So you're like, I got to get out of here. Everyone's an idiot. But what do? You go work for a better company. And that's normal. That's a normal part of the economy. Or you get hired out by a better company that just contacts you one day. You know, during COVID, I've had a lot of deliveries at the house. I mean, by big semi-trucks that can't even turn. Like, amazing amount of deliveries, and cranes and dump trucks and cement trucks and flatbeds and furniture trucks. Just amazing. I tried to keep the whole state of Georgia afloat during COVID. But I talked to everybody because I'm an economist, and it's a great way to get primary research. And I talked to all the truck drivers in particular. And it's interesting where Some of them have, I got a lot of stories, and one of the stories were, the guy and a couple of his buddies that are also drivers, they were just sitting at a coffee shop having, coffee, and their trucks are out front, and out in the yards, right? And anyway, somebody came right in and was handing out business cards to them. They're like, "Come work for us. Come work for us. We'll pay you more." Isn't that amazing? That's a normal part of the economy. Come work for us. Okay? I know someone else that works for a company that manages the logistics and supply chain, and so they have a lot of truckers. I mean, hundreds of truckers. And they pay some of their truck drivers $400,000 a year for driving trucks. I bet you that's pretty high relative to a typical year. So anyways, having some unemployment is normal, and the Fed would argue that maybe raising the unemployment would keep the economy still healthy, but lower some of the inflation. I might argue against that, but it's not my job to argue, right? It's my job to make money. So anyways, that'll be very interesting. Another dumb prediction. And of course, people are going to extrapolate whatever ADP number comes out, and they're going to talk about NFP. But I researched that. Now the research's old. Actually, I didn't research it. FX Bootcamp used to have a wonderful, fabulous human being who acted as our quantitative analyst. Yeah, we had a quant. Kurt Worley, one of the greatest human beings you'll ever meet. And I said, "Hey, Kurt, I heard this on TV. Some talking head said because of ADP, NFP is going to be such." So I think they said, "Oh, a good ADP predicts a good NFP." What happened to him? Oh, he's like a chief data scientist at an awesome firm. Anywho, I said, "Hey, Kurt, is that true? Does ADP predict NFP?" And so he went back many, 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 many years. We actually got all the data, and we found no positive or negative correlation at all. But then you're going to say, "Well, Wayne, over the last 10 years, they have been extremely correlated." I'm like, yeah, that's because the Fed is manipulating the economy. And by manipulating, I don't mean good or bad. I mean, they're involved in the economy. Quantitative easing will drive up asset prices and employment. So on both measures, you will see the effects of quantitative easing, for example. But it's only been in the last 10 or 15 years that the Fed has been in total control of the economy, and therefore have that correlation. But if you go back the other 100 years before the Fed was doing things like quantitative easing, instead all they did was interest rates, and that did have an impact, but not as much as QE. And anyways, when we actually looked, and this was again before the days of quantitative easing, okay, so this was before the 2008 crisis. So we might have done this in 2005, 2006, 2007, somewhere in there. And so we look back, I don't know, 10, 15 years, whatever, how far back ADP went. And there was no correlation whatsoever, not good, not bad. Because see, if it was negative correlation, what you would do is if ADP was good, you'd short NFP. If it was positive correlation and ADP was good, then you would long NFP. And that's what this person on TV was talking about. Again, before quantitative easing existed. And he said, "Oh, good ADP, that means we're going to have good NFP." And statistically, that was nonsense. That guy's alpha was dog poo-poo. And at some point, it would be great if we can get back to a free market. Okay? Okay? That would be great, because then we'd have reality Hopstogrality. All right. So that's ADP. Thursday, as you probably know, is all about the Bank of England. Okay? So I want you to think, or I don't want you, you could think about what you believe is going to happen, not just on Thursday, but the trend of what the Bank of England is doing. And try to position yourself days before the event in a trade with your expected outcome in mind, with a stop already at break even. So that when you get to the actual announcement, okay, you either get paid or you get out for zero. Okay. Tim loved Kurt. Yeah, Kurt and David were wonderful people. I really liked Rob, but then we ended the relationship poorly, and I'm not sure. Whatever. So, and then Chris was a dog with fleas, but anyways. So then we get through the BOE back to Aussie. So obviously Aussie is going to be a mover. There's going to be some vol on the Oz. Okay? Aussie vol week. Okay, and then on Friday we got this little thing called non-farm payrolls. It's super hyped. The reality, even though it's super hyped by the media, the reality is it's summer, man. It's quiet. Yes, it's important. They're always important. They're all important. Yes, the Fed is looking at these things, but the Fed, it's important because we expect the unemployment rate to go up, destroying demand and destroying inflation. Well, many things that it created inflation are already down. Okay, oil's down 20%, wheat is down 50%, lumber is down 50%, copper is down, so on and so forth. Nat gas is all over the place. Okay, but whatever. So the Fed increasing the unemployment rate from 3.6 to maybe 4. I don't think they want to go to 4.6. So having this go up would, in theory, the models would show that inflation comes down. And it would, but moderately, because again, I think we have different things that would change inflation. I don't think the Fed had any impact on inflation. This is just my point of view. The Fed added $5 trillion to the economy. I don't think any of the Fed money created inflation. Okay? Not more than like tiny amounts, right? Like, I think we'd have 2.2% inflation right now because of the Fed. I think what happened was the Fed and the White House did not coordinate with each other. They did not talk to each other. They didn't call each other. I don't know if there's animosity in there. I don't know the politics of it. I know the Fed wants to keep independent, but we were in a global crisis. And what it looks like is the Fed and the White House were not talking. So I don't know whose fault it is. But I believe if the Fed knew the federal government was also going to add $5 trillion, they would have played things out differently. So it came from the fiscal policy. And it was the amount, $5 trillion, and the way, stimulus checks. it was economically silly. So, Franklin Delaware Roosevelt. Was that his middle name? Not Delaware. Anyways, maybe it was. FDR, actually, the FDR has an amazing history here in the state of Georgia in the United States. I've actually sat in the same spot where he sat when he contemplated what to do during the global financial crisis of the 1930s. Isn't that interesting? He came here to Georgia, and there's this hill, which I go to probably once or twice a year. Delano, thank you, not Delaware. And so anyways, there's this rock. It's still not much of a thing. There's barely even a monument. It's hard to even find. There's a tiny little parking lot. Like, it's no big deal. Nobody knows. Nobody cares. And he sat there looking down on this beautiful valley of nothing but farmland. So you can imagine if that's nothing now, imagine what it was like in 1930, right? And he sat there contemplating how to rescue the world, in particular the United States, from the global financial crisis. So during the 2008 global financial crisis, I went there and I sat in the spot. I sat and I asked him. I talked to him. So anyways, his response was giving people work. And there were a lot of things going on at that time, a lot of work projects. If you didn't have a job but you wanted to work, you wanted food, you wanted money, government will take care of you. Okay? And this goes back to Keynesian economics of when the economy is poor, the government steps up its spending so it can create demand through productivity. Okay? There's no economist that I know of. I mean, I'm sure there's somebody, but let's say nobody at Harvard or Princeton or Yale or Cambridge or Oxford or wherever that, some legitimate institution would never recommend just handing out money for free. It's terrible economics. Because what it does is it just creates absolute total rampant inflation. Terrible idea, just ridiculous. And so that's where it came from. When I was talking about FDR, what he said is, if you want to eat, I will pay you money to build a hiking trail through the mountains. We don't need this thing, but we created a bunch of state parks. Okay? We created a bunch of national parks. So let's just build a whole bunch of hiking trails. We'll pick you up. We'll take you out there. We'll feed you. We'll pay you. It's great. And America has that all over America. These hiking trails made by people that were jobless during the Great Depression. I've been to many, many, many beautiful post offices across America that were built during the 1930s through the FDR New Deal, where they paid workers to build beautiful public buildings because people were out of work. They got food and money to take care of their families. And 75, 80 years later, the public is still enjoying beautiful buildings built during that period. There was productivity and return on investment. Now imagine not just a beautiful public institution, but one that lasted almost 100 years. Think of the return on investment. And there were all kinds of many interesting things going on in the world at that time. Also think during the Great Depression, the Golden Gate Bridge was built. It was the first first bridge ever built with the use of nets and hard hats. The hard hat was invented building the Golden Gate Bridge. And they only lost one man per million. What do I mean by loss? One death. Only one person died per $1 million spent. Now imagine $1 million in 1930. That's a lot of money. Hardly anyone died. It was one of the safest things. Meanwhile, the Empire State Building, the Chrysler Building, the Woolworth Building, all these big giant skyscrapers were just exploding across Manhattan during the 1930s. Pretty interesting time. But think of the productivity. If you have productivity, you don't have inflation. Think of that. If you have productivity, you will not have inflation. We have inflation because we gave out $5 trillion with no return on investment. So that's where the inflation came from. Cool. Okay, so that answers that. So the Fed can do what the Fed can do. Raise interest rates, quantitative easing, remove some of their $5 trillion in stimulus. They added it through the bond market. They can remove it from the bond market. The federal government needs to remove $5 trillion. The only way that the federal government can do it is raise taxes. And then you'll think, well, politicians don't want to raise taxes. It'll kill them. It'll kill their career. Well, then they shouldn't have given out free money without return on investment. Okay? There's a lot of negative consequences. And that's why we didn't do it during the 1930s when we had a depression and 10, 20% unemployment. Okay? Stock market crash. We had all of that during the same time. Okay? Again, my other argument is since 2008, let's say, the Fed did quantitative easing and could not create inflation. They couldn't do it. They were trying. For 30 years, the Bank of Japan did quantitative easing and was not even close to being able to create inflation. QE doesn't create inflation. Okay. So anyway, so that's been proven. I think that'll be the last time you'll ever see stimulus checks. Ever. Think of it this way. Let's say I'm doing a Forex conference. And I'm on stage and you're there. And I'm like, hey, thank you everybody for coming to the Forex conference. This was great. This was epic. What an amazing weekend. But without further ado, let the party begin. There's free booze at the back of the room. We're going to have a DJ. We're going to have some lights and we're going to have balloons and smoke and lasers. And let's have a party. Free booze. There's, let's say, 1,000 of us. And you get there and there's enough booze for 150. There's incredible amounts of demand right? But not enough supply. Okay? So you could just be first in line and grab as much as you possibly can and hoard all. So you're like, I'll take 10 beers, and you grab your 10 beers, as much as you can carry, and then you put it on the table and you guard it. That actually happened during COVID, didn't it? When it came to like things like toilet paper and disinfectant. You couldn't get any. People were buying it and hoarding it. Of course, if they sold it on eBay, they sold it at high prices. And that's the other thing you could do is, yes, the beer's free, but you get to the bar and you can see there's not enough. And so you're like, you slip the bartender $10 and you're like, hey, pour me some beer. Huh? Hey, over here. Here's $10. And you give him $10. Now you're paying $10 for free beer, but you got the beer. You see, like all of a sudden prices go up. Okay? Well, Sultan says, oh, respect, but technical analysis is everything. And if you understand the language, well, but then why do you come in and you're like, what do I think about oil? If you understand technical analysis, then once again, there's no process of thinking. You look at it and it just is. What do you mean? Okay? The problem with technical analysis, if there is a problem, is it doesn't predict the future. It tells you now and it tells you before. There are some leading indicators that I use, but they're guides in the same way that fundamentals are a guide. Was that right, Meta? Is it good news? I hope it's good news. Yeah, that's right, Meta. Yeah. Oh, I just closed the window. Hang on. Oh, no. I know. I closed the window to get to my email. Hang on. Where did my email go? Lost it. Oh, there it is. Where's the YouTube chat? There we go. There we go. Yeah, no, yeah, that's the other crew. Yeah. What am I doing now? Oh, I have to go over here. Sorry. Typical man. I can't do two things at once. All right, so let's get going. Dollar is still on the weak side. I wanted a different one. Let's go to maybe, was it over here? Yeah. Yeah, so here's where I was talking last night. I would personally have expected, or not expected, but looked for it. I did. It's not even I would. I did look for the potential of a double top and a drop from here. Okay. Isn't that interesting? And it didn't go up. I mean, it didn't go down, which is fine. So in the day trading group, we talked about analysis that suggested this would go up. And I'm like, I get it, because I could see that that is what has been happening. So this is the idea of technicals. Technical analysts love the fact that eventually it bottoms out, makes a higher high, higher low, buy. Higher high, higher low, buy. Higher high, higher low, buy. Right? Higher high, higher low, buy. higher high, higher low, and you will continue to do this forever. And that is correct in the moment. Okay. Now, for this to be true for much longer, let's say this is going to continue for 3 months. Okay. What would need to happen in other markets? Because I have a Newtonian physics point of view of the markets. I believe the financial markets work like clockworks. Okay? So if that is going to happen and continue up for 90 days, and this is the bottom, that's also the bottom of the stock market. That's also the bottom of the bond market. Okay? Bond prices have rallied since this day, lowering yield from 3.5 to 2.6 on the 10-year. But you can go to even junk bonds and prices are up and yields are down. Okay? The S&P 500 bottomed out around there. The Dow bottomed out around there. And at that time, Kiwi dollar bottomed out and started going up. Primarily, I would argue, on dollar weakness. So you could see stock market down, dollar strength, stock market up, dollar weakness. That is normal. But like I said now, we're talking about fundamentals now. If this is going to last 90 days, the stock market has to keep going up. All the risk about, what's going to happen in Europe with nat gas and the war in the Ukraine, all of that is nil. Right? The Fed jacking up interest rates to terminal levels is nil. All the risk is gone. It's all game on from here. And the stock market is going to continue going up for 90 days. How many people believe that is true? You believe the stock market will continue going up for 90 days straight? Well, it's a question, Math 77. Okay? Then, if you believe that statement to be generally true, because there's always going to be ebbs and flows, right? Then this is what you are trading. Now, yeah, well, nothing is straight up, nothing is straight down, right, Joseph? But generally true, and price action would dictate that, okay? So if that is generally true, you will be shorting the USD and probably the Japanese yen and probably the Swiss franc. Now, if you say, well, this was shorting, and now in the middle of July, big institutional investors are on vacation and they've removed their risk. And then when they come back from vacation at the end of summer, all those risks that we were worried about will become a worry again. What will Putin do? What will energy prices do? What will other commodity prices like food prices, energy prices, what are they going to do? What is the Fed going to do? Are they continuing to raise interest rates? Has their tone changed where they're going to maybe slow down interest rates but keep raising for longer, slower for longer? Is the terminal rate 5% but only at 25 basis points at a time? Do you understand? Like, there's all this stuff down the road, which then for other investors, you might say, okay, this has gone up. I mean, guys, since this period to create this move, the S&P 500 rallied 10%. It's like 9.7% or something, right? And if we have another update, it'll be 10%. So what you're saying is to get another move like this over the course of 90 days, the S&P 500 will be back at the all-time high. Oh. Back to the all-time high. The supply chain's been fixed. The energy crisis has been fixed. Fertilizer crisis has been fixed. Food crisis has been fixed. Supply chain out of China, it's all been fixed. We're back at all-time highs. Okay? If you don't believe that's true, then the next, and this is what I talked about in the day trading group last night, okay, that we had a plan A here and a plan B here, and what you're trying to do is time the next move down. And in this case, if you're a bear, you can wait. Okay, maybe it only goes to R, and then we roll over. One of my favorite weeks of the year is the third week of August. And I wonder if that'll be important this year as far as change in trend, as it can be. I don't think it'll play as big of a role as it normally does. And in fact, it could play the opposite role. Usually it means dollar gets weak, but this year the dollar might get strong. So that would be part of your analysis, ladies and germs, that you're like, this is going up, but I don't believe it. Now, going back to Sultan, he says, well, everything's in the price is basically what he said, right? All you need is technical analysis. No, I think that's incredibly naive. And I hear it a lot, so I'm not picking on Sultan. I'm like, why would you not want to know what's behind the curtain? You know? The fundamentals. Like, I don't understand that logic. Everything's in the price. Bullshit. Now, it's important, but come on, dude. Really? So, what I would say in this case is you would have this fundamental bias in blue, and what you're doing is you're analyzing the price action and trading the price action. But that's how you can then set up this idea of, as long as the price action is going up in the short run, you're short term long. So you might be like day trading and maybe swing trading. Certainly day trading up. You buy the dip, take profit off the top. Buy the dip, take profit off the top. And you're using your weeklies, and everything's golden. Everything is right as rain. I'm perfectly happy with that. Okay? In fact, this up move was predicted last night, even though it went against what I was looking for. Well, that shows you that I'm doing both technicals and fundamentals, and I think that's important. But the thing is, when you get here, you're like, uh-oh, now you're long-term short. And now instead of day trading and swing trading, you're swing trading and position trading. And then you look at that through your fundamental view of the world using like Newtonian physics, and you're like, okay, what would happen in a world like that? The stock market is going down. Yields and interest rates are going up. Okay? And you get sort of a unique kind of situation where the economy is falling, we have high inflation, and the inflation is coming from commodity prices going up. Not because of a shortage of demand, and this is my problem right now with the Fed and the government and all this kind of stuff. They're going to kill demand, but I don't believe that's going to be the problem. They will kill demand, but there will be a shortage. Imagine 1,000 people trying to get 150 free cocktails. There's just not enough. Well, not everyone's going to, most people will just leave and they're like, well, I couldn't get a drink. It sucks. I don't want to stand in line. It sucks. But some people are like, I need that. I need that drink. Okay, if we're talking about oil, if we're talking about nat gas, okay, imagine a recession in Germany. Let's pick on Germany for a second. Germany goes into recession. Unemployment is up. What percentage of people want heat during the winter? Yeah, no, Salado Club, I think that too. So I try to use it in a positive way. Yeah, so all right, so let's pick on Algeria. Algeria is a major importer of Russian and Ukrainian wheat. There's not going to be enough Russian and Ukrainian wheat. What percentage of Algerians are going to want to eat this year? Right? So on and so forth. So we may destroy demand for what, and here's the thing, it's called aggregate demand. So if you lose your job, less people will have free cash flow, aka money, to eat at Applebee's. So Applebee's will have less customers. They don't need as much staff. They lay off some waitresses. And the owner makes less money because he gets paid, or she gets paid through distributions at the end of the year, not necessarily just a salary. They own the place. So they make money this year. So if they own, a couple of Applebee's, maybe they make $400,000 a year. So now they're only going to make 150 this year because it's a recession. Not enough people are showing up. They lay people off. Now, the woman that was a waitress at Applebee's doesn't have enough money to get her highlights done at Supercuts. And so Supercuts has less demand. The owners make less money. They lay off a couple of stylists. And now the stylist doesn't have money to eat at Applebee's. What percentage of those people that are losing jobs still want to eat food and still want to have heat in their apartment during the winter? And then you say, well, why is that important? Because that's not aggregate demand now. This is now we're targeting demand. Okay, this has to do with a concept called elasticity. Well, let's just say demand for shelter, so your rent or your mortgage is super important to you, right? Having food is super important to you. Now, as prices go up, you might do substitutions. And again, this is an economic thing where you're like, well, you can't afford, let's say fresh orange juice, but you get frozen concentrated orange juice. Or instead of real orange juice, you buy purple stuff. Call it juice. And you're like, but there's no grapes in it. It's just purple water, whatever. Okay. And you make substitutions. Instead of fancy butter, you buy margarine. I don't know. There's a substitution effect, right? Instead of steak, you're eating chicken. But you're still going to eat. Okay? You understand? And then things like heat, things like gasoline for your vehicle. Maybe you don't drive around as much, but you're looking for a job. You're going to interviews. You got to pick up your kids from school. So you got to put, gas in the truck. Okay? So these are economic variables that I'm pulling out of aggregate demand, and the Fed is impacting aggregate demand by making money more expensive and slowing the economy down and all that kind of stuff. But it won't impact the three things that are driving up inflation in the United States and likely other places in the world. Housing prices or rent, right? Rents are up and rents are sticky. Wages are up, wages are sticky, right? Fuel and food, so we'll say commodity prices are up. And even though they come and go, there's a lot of volatility to them. Most likely we're going to have a shortage in the future. And if that's true, we'll have a slowing economy and stubborn inflation. And the Fed, at some point, I hope, and there's a risk they don't, but I hope at some point they realize their policy isn't working. Okay? Why are energy prices high? Oh, because the war in the Ukraine. Bullshit. Partially. But we had a problem before anyways. Europe and the United States have been telling oil companies for a long time that they're bad people, they're bad companies, they're doing bad things. We're all going to drive Teslas. You're polluting everything. You're doing everything wrong. So you got to have all better technology to do all this stuff. And we don't want your oil and gas. And they said, okay, well, that doesn't sound like a good opportunity for long-term investment, because if you're going to drill a well, you need $8 million minimum to do it right. And that's just a wildcatter. If you're going to build, like ExxonMobil is going to build a new facility, it's going to take tens of billions of dollars. It's going to take 10 years to make, and it's going to take 40 years to recover the investment. But energy went to zero, so that's not good. You can't afford to build when oil prices are at zero. And then the government tells you you're bad. So they're like, well, screw you, we're not going to invest. Or quite likely, it just wasn't good investment opportunities. And so you decide, well, let's build something in Kazakhstan because building something in Texas takes too long, too expensive, and they don't want us there. So you go build somewhere else. So now when suddenly everybody wants energy, they're like, well, dude, you told us we were bad. You told us we had to follow all these rules. We had to have all these lawyers and accountants and testing. And I'm not saying they're not necessary. I'm just saying that was being applied. And meanwhile, prices were low because we're fighting OPEC. You remember when oil was free? Well, then oil went up, and the government said the oil companies were bad because they were gouging Americans, stealing their money. They're like, dude, 2 years ago it was free. You weren't bailing us out like you're bailing out the car industry and the airline industry and the banking industry. You weren't bailing out the oil industry, and now you want oil. Like, dude, we haven't explored for new supplies. We don't have new refineries because you didn't want it. You told us everyone's going to have a Tesla. Oh, that's right. Thank you, Joseph. Absolutely correct. Yeah, the OPEC one. Yeah, it would be great. I don't think anything will happen, but it'll be interesting to watch. But anyway, so what I'm trying to get to is there's a problem. And then, so if we're not discovering new sources and we're not drilling new wells, because it's just too expensive and unwanted by the American society, then we just don't have new supply. And it's a supply issue, isn't it? And then where do you get fertilizer? Well, you get fertilizer from potash and you get fertilizer from nat gas. And guess what? We don't have enough nat gas. We don't have enough terminals or refiners to turn nat gas into fertilizer. And besides Canada having 1/3 of the world's supply of uranium, and by the way, 1/3 of the world's supply comes from a very small part of Canada. It's not like there's uranium everywhere. Basically, Saskatchewan and a little bit of Alberta as potash. That's 1/3 of the supply. It's not a lot. And where does the other stuff come from? Oh, the Ukraine and Russia. That's going to be taken offline. So where are we going to get fertilizer? Fertilizer is used for food. We're going to have a lower yield of food next year. Food prices are going to go up if you want to eat, because we're going to have the same amount of people wanting to eat regardless of the economic conditions. But we're going to have lower yield because fertilizer prices have gone up 300%. You're not going to want to pay 300% more for food, so farmers are just not going to use it. So where yields are going to be lower because they're going to not use fertilizer or use significantly less. So we're going to have less food, the same demand per person, and, technically we'll have more people on Earth. So good luck, Fed. Good luck, ECB, killing inflation. How high do you need to raise interest rates to get food prices down? It has nothing to do with interest rates. How high do you need to raise interest rates to get oil prices down? Well, it doesn't really have anything to do with interest rates. Unless we all own Teslas. Then then all the ships on the sea will have to be battery. Okay? What percentage of electricity comes from natural gas? 36% of global energy comes from coal. Coal. More than 1/3 of all global energy still comes from coal. There's a lot of nat gas being used. Oh, wait, we're going to have a shortage of nat gas. You see? So if I were, listen to this will be great. If I was president of the United States, I would not be drawing down the Strategic Petroleum Reserve, but I would create some sort of, an amazing incentive for the oil industry to produce. And I mentioned this a long time ago, like guaranteeing $100 a barrel for a certain amount of time, relaxing some of the ESG, environmental regulatory oversight. Now you're like, well, that's, there's some danger to that. So that would have to be well thought out. Of course, I haven't thought that out, but more like I would want to make it easy for the oil industry to increase supply now and make the long-term investments for the future. More refineries, more terminals. Okay. More production. But also invest some of that money into better technology so the production is cleaner. Capture the methane as it leaves the fracking wellhead instead of just going into the atmosphere. And instead of burning off nat gas, okay, check this out. Catch it at the vertical separator and send it down a meter line. Huh? Everybody that's taken the oil trading course knows exactly what I'm talking about. Oh yeah, the vertical separator. Oh yeah, there's going to be a pipe that comes out the top and it's going to come down there and we'll send it down the meter run and you'll actually make money instead of burning it and flaring it. Because you know what flaring means, and you can even picture it. You can picture the view from space. Wink, wink, nudge, nudge. Maybe you want to join the oil course. The link is in the description below. It's still 50% off. Okay. Yeah, but capturing the methane, capturing the nat gas. Yeah. Yeah, all good stuff. So whatever. What I'm getting to is I want you to be able to develop both a fundamental and technical plan. So I want you to be opinionated. I don't like it when you come in and you're like, it's all in the price. It's up, so I'm up. I don't need to know anything else. Okay. You will stay small as a trader but that's okay. You're not going to be able to raise money. Yeah, I mean, you can raise money from friends, families, and fools. Okay, that's fine. And you'll be really good. And you'll make money, and you'll be fine, and you'll produce value for people. That's fine. But you'll never get big because the value you're producing at any given moment is small. You made these pips, you made those pips, and every day you're starting from fresh. And you're not enjoying things like compounding, okay? And to be able to make that kind of decision, you have to look into the future. You can't just look at right now and just say only price action, okay? Because you'll never be able to say long-term short. You'll just be like, oh, well, I'm going to buy this dip on the roll reversal and take it north. Cool, fine. But you won't be able to, when somebody says, because, I've met with, a lot of people. I mean, I'm just thinking how normal it is for someone so I'm thinking of a situation where this billionaire in Atlanta, he does business in all these different countries. He has a full-time staff in Switzerland that only hedges his foreign exchange. They do enough business in Switzerland that they basically gave him a Swiss passport. He's basically a Swiss citizen because he does enough money there, just hedging his positions and all that kind of stuff. And when you meet somebody like that, they understand global macroeconomics. They understand the value. He said, Wayne, sometimes I don't know if I run my business as a business or if the business just allows me to trade foreign exchange. He's like, I don't know if it's foreign exchange that I do or my actual business. I mean, he's big enough. He owns his own ports and stuff like that. But he will ask, what do you think the economy is doing? What do you think the global economy is doing? What do you think the dollar is doing? Where do you think we'll be in 6 months? Where do you think we'll be in a year? Why? What variables? What goes into that model? How do you get to that conclusion? Because not only does he talk to me, but he told me, and I'm thinking of a specific moment in time. I showed up to a board meeting, and at the previous board meeting, he asked me what I thought, and I told him, I'm like, not a problem, right? And then at the next board meeting, I walk into the room and he just pushes everyone out of the way and he crossed right through the room and he's like, Wayne, you were right. And I'm like, yeah, I know I'm right. And then, right, arrogant, right? But anyways, I put thought into it. And he's like, look, and he talked about he's got very, very big bankers, right? Big, huge multinational banks. And he meets with, very high level people because he does billions of dollars in transactions with these banks. And he's like, they knew less than you did. And I'm like, oh, cool. He's like, I learned more from you in 3 minutes than sitting with these guys for 3 hours. And so I want you to develop that type of value creation too. But then still be able to trade short, medium, and long-term charts. Scalp your way into day trades, right? Day trade your way into swing trades. Swing trade into your positions. With positions, you can build portfolios. And portfolios reference your biases because you can think 3, 6, 9, 12 months in advance. Now, you might not be perfectly accurate, but you have a model, a base case, in which you can trade and adjust as more information is revealed. And I wouldn't want to be in the situation where I don't know what's going to happen next week, next month. I have no idea. So I'll drop into my 15er and react. and the trend will be my friend until the bitch stabs me in the back. I used to do the speech, something like that, where, you got to love her and take care of her and shower her with affection and attention, right? And your efforts will be rewarded. And of course, I'm talking about the trend, right? And keep doing that over and over until the bitch stabs you in the back. And that's the trend. She'll betray you, stab you in the back, take all your money, and you're like, no! Right? So, you got to be careful. It's not all price action. But price action is beautiful and wonderful. And it helps you identify the right price in which you would buy or sell. Okay? Now, these are big levels of volatility, which are telling me it's getting toppy. And then I think about it fundamentally, and I'm like, you know what? By the third week of August, I wouldn't be shocked. Between now and the third week of August, I might be a seller. So I want to look at it this way. And by the way, listen to my tone of voice, right? This is going up. I'm fine with that. What I would like to do on the medium term is I would like to sell it. I look at this and it's not a sell-in opportunity now. Okay, I look at that as a higher high. So at some point, my theory tells me that what we could do is at some point come down. Now, what point? This suggests that we're going to go to 65. So in about 150 pips, I have permission to get bearish. And once again, using technical analysis, and this is a leading indicator, not a lagging, this predicts that. The other part that I understand about the market is if we get there too quickly, we are coming down. By the end of August, we'll be here, and by the end of September, we will be here. That's a theory. That's a hypothesis. That's a model that I'm building. Is it going to be true? I don't know. But now I use all this information. So I have market and price and fundamentals. I'm looking at it all. I'm looking at fundamentals down. Okay? Market are the pivot points, and then sort of the behavior of it. I understand how pivot models work. And then I have the price action. So I use all three, and I'm like, well, it'll be interesting if we're below here. Let's just say, I'm not making a prediction. In fact, I don't think it'll do that. But let's say it came down, and at some point, these moving averages roll over. I have permission to engage if that happens. I'll play it like an M3. Let's do this in blue. I'll play this like a monthly M3. Okay, lower high. And I'm going to take it down to MM1, which is not even on the chart here. So I'll sell it at, I'll probably end up selling around 63, taking it down to 60, maybe even lower. How would I even know even lower? That would be the fundamentals. You see what I mean? That would be my fundamentals. Am I going for 60 or am I going to 50? Well, that would depend on the stock market, the bond market, Okay? The commodity market. Commodities often are impacted by these two because they are impacted by things like household wealth effects and stuff. But I believe it's going to be reversed, and the commodities are going to impact the stocks and bonds. So let's say if commodities go up, stocks come down, dollar goes up, and we're on our way not to 60 but to 50 on Kiwi dollar. But frankly, I'd probably rather sell something else than that. I'd rather, if all that happened, dude, euro dollar's going to go to 80. Screw parity. 80. Forget 90. 80. How do I know that? Well, I have to do now fundamental analysis of Kiwi versus euro. All I did here was analyze what would impact the dollar and how it would impact other markets. So I would be hedging my stock portfolio. I'd be trading commodities like a monster, like a beast. Okay? I'd be gobbling up US dollar. But because of this part here, probably selling euro, probably selling pound, probably buying CAD, probably buying Aussie and Kiwi. Therefore, I don't want to sell this at all. I don't even want it. And now that gets interesting, huh? All right. I have so much to do today. Oh my gosh. Got up early and everything. Still, I don't know if I can get everything done today. But I think it's going to be great. I'm going to probably focus on the MyOMI WTI. I want to watch for rollovers on buck. I want dollar to be strong because I think it's going to be strong. Now, unfortunately, strong dollar means bad world. But I don't mind that the stock market's rallied 10%. I don't. But the chief investment officer for Morgan Stanley Wealth Management said, oh, what did she say? She said, wishful thinking. I think we got a lot of risk out there, and what has gone up can fall. So I'm just wondering if I should get out of some of my positions with the 10% and then add that to my hedge. Okay? Peace on earth. May the pips be with you. May your profits be above average. We're going to have a very interesting week. I can't wait to see you tomorrow. Meanwhile, if you join FX Bootcamp, you can join the day trading group. We'll meet tonight at 7 and then tomorrow at 2 a.m. Or just sign up for the training courses. They're $88. 65 hours. Cheers. Hey, that just happened.